Well, welcome everybody. We're going to get started today. Thank you for joining us. This is by far our most popular webinar, and it's popular because I think everybody is starting to understand that building a hospitality group is essential to succeed in the industry. And Andrew and I have been helping people open and roll up into hospitality groups for years now, 8 years for Andrew, 20 years for me. And we've just seen so much success emanate from people understanding and embracing what it is to think about the industry in a different way. Used to be, you could think about the industry like, I'm going to open up my dream restaurant. And back when I was in business, you could do that. Margins were at 20%. Most of our business was cash, which was helpful for obvious reasons. And now things are different. So back then, that 20% was even more, perhaps. And now we're all striving for 10. So do the numbers. And it becomes tough to just open one. So we have to change our mindset and we have to start thinking holistically in terms of what is the hospitality industry and how can we benefit from our hard work and growing our brand. And that's what we're going to talk about today. So let's get into it. Andrew Fine is the corporate chair. He's also my partner.
Morning,
And
buddy.
he, day in and day out, he's working with our entrepreneurial clients who understand the value of building a hospitality group. Andrew, how are you?
I'm doing well. Thanks, David. Appreciate the intro. Happy to be here.
Andrew has a little bit of a cold or something, so if he starts sneezing and coughing, forgive him. I will take over. But
For
but
everyone's benefit, I'll go on mute and off video just to spare you all from that, but I appreciate everybody's understanding in advance.
yeah, let's get rolling.
Yeah,
How to build a hospitality group. Slide number one, legal disclaimer. Andrew, what do you want to say about this?
sure. We have to put these in front of every webinar that we give. Basically, this isn't legal advice, right? We're going to be speaking in kind of broad generalities today, talking about, what we typically see, but every fact and circumstance is different. So if you have questions about what makes sense for your particular group or your particular venture, definitely reach out to us and don't take our word on these webinars as gospel. This isn't legal advice. This is really just for informational purposes only.
That's such a nicer way than when I say it. Usually I just say, this isn't legal advice, blah, blah, blah. But thank you, Andrew. I do appreciate your take on that. So let's get started. What's a hospitality group? What are we even talking about?
Sure. So, I mean, a hospitality group is basically it's a collective, right? It's a series of bars, restaurants, F&B outlets, kind of under common ownership and management. You may have heard the term kind of multi-unit operators. Owners of hospitality groups are exactly that. They're just multi-unit operators. Um, and it's a collection of not just actual brick and mortar ventures, but it's a conglomerate of owners, right, who are working together on multiple ventures, whether it's, five locations of the same brand or it's five, differently branded restaurants under the same umbrella. These hospitality groups can take, lots of different forms and can look different ways, but the ultimate goal is to consolidate ownership, right, and to take advantage of economies of scale. That's really the number one motivator for why people bother to go through, the legal hurdles to clear the legal hurdles of actually creating a management group and a holding company is to take advantage of those economies of scale and to streamline things a little bit, right? So that they can start to take advantage of better profit margins and leverage a larger brand to get better results.
Yeah, I
Um,
think it's important that our clients and our friends who are listening expand their idea of what they can do in this industry because forming a hospitality group is not just a series of exercises where you're just putting together companies. It's
right.
really about a philosophy. That philosophy is how can I expand my idea of what I can do in the world of hospitality? And you'll see a lot of people doing this. I just read an article about our clients at Catch on LinkedIn, and they said, we're not just a restaurant company. Now we are a lifestyle brand. And you hear that a lot, maybe overused, but it encompasses a lot of different things. So hospitality is not just restaurants and bars. It's CPG, consumer product goods, it's hotels, it's media appearances, it's management deals, it's licensing deals, etc., etc. So that's what we're talking about when we talk about forming a hospitality group. We're doing it so we can take advantage of other opportunities.
Right. And to David's point, it's not just brick and mortar spots either, right? You can have pop-ups. We had a client enter into a series of deals with a golf course, right? To basically cater certain events for them. And that was kind of a new expansion of their hospitality arm, right? We have other clients doing, one-off license deals internationally, or, they're getting more creative with what they're going and doing. We have another client that's starting kind of a teaching branch or a consulting arm to help other brands, right? Leveraging off the success of their brand. So part of this webinar the goal of this webinar is to not only explain how, right, to build a hospitality group, but why, right? And to understand that it's not a one size fits all. You can kind of creatively decide what efforts or do you want to prioritize? Where do you think kind of, your niche in the market is? And taking advantage of it in different and creative ways. This may seem kind of
Right.
formulaic. We'll be talking about generalities, but understand that this process is actually a very creative one. And there's no right or wrong answer a lot of the time in how or should you, do certain things.
You talked about pop-ups, Andrew. We have a client who loves pop-ups. In fact, they're doing a pop-up with Rayo's at the Super Bowl in New Orleans, and it's a week pop-up to take advantage of all the people coming into town. They also do pop-ups at golf events, et cetera, et cetera. This is a company that already has a bunch of restaurants, but they're seeing opportunities because they have that mindset of what else can we do to bring some money into the hospitality group. It's a beast that you have to keep feeding. So let's move on. And by the way, everybody who's listening, feel free to ask questions in the chat box. I'll screen them all. If I think that they're relevant as to where we are in the presentation, I will ask and answer those questions. So please feel free to do so. Andrew, how do you build what are we even talking about? What is a hospitality group? What does it look like?
Yeah, so we'll create some visuals as we go through these slides. We're going to start with the basics. I know most of you on this call kind of know this already, so we're going to kind of rush through some of the more basic points. But the first step when you're thinking about a hospitality group is obviously you got to build your infrastructure, right? Ideally, you will assign a separate LLC to each of your businesses and locations. As David mentioned, that's not necessarily just each brick and mortar, right? If you start a virtual business or virtual consulting arm, you might want to create an LLC specific to that operation as well. Basically, anytime you have a distinct business or a distinct line of revenue that will have its own contracts and its own kind of business going on, you want to basically assign a new LLC to that. You'll see LLCs used a lot throughout this presentation. Um, a lot of entrepreneurs are between forming a corporation or an LLC for kind of their first project. We would, in most cases, strongly recommend going with LLCs over corporations because LLCs are more flexible and they're easier to stack. I always caution clients when they're thinking about starting to kind of build a hospitality group or hospitality empire, whatever you want to call it. I discourage them from forming S corporations because those are very hard to fold into a bigger picture. A lot of what we'll be talking about today are possible with LLCs. They're actually not possible for S corporations because you can't very easily stack them on top of each other or have them be owned by other companies. So we're talking about building our infrastructure. We're creating LLCs for each business venture, and those become the building blocks that we'll build on top of, and we'll show you in subsequent slides what that kind of
Now,
looks like visually.
you say they're more flexible,
Mhm.
Andrew. What do you mean by that? What makes an LLC flexible?
Yeah, a few different things. LLCs are generally newer as a vehicle than corporations, so they're a little less old school, right? There's not as many corporate formalities you have to observe with LLCs. They were designed basically with small businesses in mind, right? So there are fewer formalities you have to observe, which generally makes them more small business friendly. But there are rules that attach specifically to S corporations. They have to be owned by human beings. They can't be owned by other entities. So if you have a friend who has a, investment fund and he wants to invest in you, if you have an S corp, you say, oh, sorry, you can't do that. Whereas an LLC, the answer is most often yes. You can also create different classes of equity in an LLC. You cannot do that in an S corporation. That is very important because you can basically create a group of investors and give them different rights than you as a founder.
Like what? Like what's typical in our industry?
Yeah, so if you're raising money in a hospitality company, your chances are you're dividing the company into two classes of equity. You'll have a founder class and an investor class. Class A is the founder class, and Class B is the investor class. That's typically how it's framed. Class B, you want to keep mostly passive, right? You don't want them to have necessarily voting rights and control over the day to day because most investors don't know the first thing about running a hospitality business and you do. It's the whole reason they're investing in you is because they're placing faith in your ability to do that. Um, you're also probably going to offer investors something called a preferred return, which is a priority profit interest. Let's say you're selling 30% of the equity in a business to investors. You might tell them that group, look, you own 30% equity, but I'll give you 80, anywhere between 80 and 100% of profits until you get your money back. You'll pay yourself, a management fee or a salary until that point to make sure you get paid something in the meantime, but it's a way to accelerate investor payback. Not only is that expected by investors, it's actually a good thing for you as a founder because if you didn't do that, you'd probably have to sell a larger percentage of the business to get them paid back within that same period of time, right? Depending on your projections. Yeah,
Investors like to get paid back quickly because it decreases the risk. And that's what investors are afraid of. They're afraid of the risk. You want my money? I'll give you my money, but what's my risk? If you tell them you're going to pay them back in 3 years rather than five, they're more likely to give you money. And you're more likely, right, Andrew, to hold on to a larger chunk of the business.
exactly. So in the long run, you benefit by taking a larger chunk of the equity in the long run, particularly as you scale, right? Because you'll raise money for your first location, maybe your first two locations at a time. But if you want to open 10 locations, you're going to keep raising more money and dilute yourself each time. Dilution isn't necessarily a bad thing, right? It's an inevitable symptom of growth. I'd rather own 10% of a $10 million company than 50% of, a company worth 500K. Dilution is not a bad thing, but you want to be careful each time you raise money not to sell too much with the understanding that you're going to get diluted each time. So offering preferred returns is really important for a hospitality owner because it preserves a larger chunk of equity for you as the founder. Can't really do that in an S corporation. So people who try to raise money through S corporations generally have to sell a little more of the company, and it makes it much harder to scale that company for a whole litany of reasons.
I have a
Um,
question for you, Andrew. This is from one of our clients. Let's just say I had, I don't know, an ice cream shop and I wanted to open one up and then I wanted to open up a lot of them
mhm,
across the country,
yep.
maybe even franchise.
Mhm.
Would you ever consider something outside of an LLC, like a C Corp, maybe?
I would consider it, C corps are a different form of corporation. You have S corporation and C corporation. That the S and the C just basically stand for kind of their tax elections. You don't see C corps a lot in the hospitality industry because they're taxed on two levels, whereas LLCs are only taxed on one. C corps are taxed at the income on their income and dividends, whereas LLCs are just taxed on their dividends or distributions. Um, you see C corps in certain industries like tech and pharma because if your goal is to become a publicly traded company or to be acquired by a publicly traded company, C corps make more sense there. Um, very, very few hospitality companies strive to be or will ever become publicly traded, right? So even if you're in a growth mode, you're probably not going for the level of growth that maybe a tech company saying I'm going to be the next Google would be.
Got it.
So it's generally not tax efficient to be a C corp. Do investors have preferences? Generally not. I know a lot of founders are concerned about that and say, "Oh, I'm working with an investor. They're used to investing in C corps." That might be true, but if the investor knows hospitality businesses, in my experience, it's better to go with an LLC because that flags for them that you know the industry you're in, right? And
Mhm.
an investor isn't necessarily going to want to invest in a hospitality business that is a C corp because they're going to think, Why did you do it that way? That doesn't really make a whole lot of sense, and you're going to end up paying more taxes than you need to. I'm not saying it never makes sense to form a C corp, but it's kind of case by case, and I'd say 99% of hospitality businesses out there are structured as LLCs, and in my opinion, for good reason.
And some people are talking about parent companies, which we are going to talk about in a minute, but generally, also, the reason why you're setting up different LLCs for everything is that if you get sued from one restaurant, it doesn't affect the others. You
Mhm.
know, labor lawsuits with nasty landlords. We had somebody have a Con Ed problem that brought down their whole uh, company. You know, it insulates your other companies. Why don't we go to the next one and start talking about how to build?
Yeah. So, once you get the infrastructure set up, right? Each of your respective businesses has its own LLC, as David said, has its own bank account. You want to make sure the contracts are signed in the name of those operating companies. You'll want to form a parent company above them if the goal is to consolidate ownership. And generally it is, right? Because in order to take advantage of economies of scale, you want to basically be able to pool your fees, your profits, your working capital so that you can take advantage, right, of those economies of scale. Without a holding company or a parent company, as it's visualized here, every one of your businesses kind of has to exist in a vacuum. You can't use profits from one company to help out another if there's no bridge connecting those ventures. So a
Mhm.
parent company creates that bridge and allows you to do that. For purposes of these slides, I'm going to assume that this parent company owns 100% of each of the subsidiaries, right, or each of the locations. You don't have to structure it that way. It's generally simpler to do it though. And I'll give you an example as to why. We have clients ask us, hey, I have a parent company, but I have an investor I want to bring in just on my first location. Can I do that? The answer is yes. But it becomes tricky the bigger you get because you're going to have costs that are shared between all of your businesses. So if I'm an investor in location one and I find out that location one is paying 50% of an employee that splits their time between three locations, all of a sudden now I'm upset about that. I'm going to want to understand how you're allocating shared costs and whether it's proportionate. That's very hard to do because, as the people on this call know better than I do, it's very hard to predict where the needs are going to be. You might have an officer spend 100% of their time at one location one month and then 0% of their time at that location the next month. They go where they're needed. It's very hard to allocate costs predictably over the course of a year. It, Having the holding company own 100% of everything lets you not necessarily worry about which company's paying for what because it's all one pot and everybody's sharing ownership at the top co.
Yeah,
So
when
I'm
you
not
split
saying
it
it's
up like that and
impossible, but
when you have somebody kind of sticking out, it's like a skin tag. It's annoying. It's not going to kill you, but it's going to annoy you.
Mhm.
They will be annoying. Trust me. You'll have one person owning 3% of one of your companies, and they will be a constant thorn in your side. It's always the case. The same with any raise. You know, we always say, what's the best makeup of my investor pool? And I always say, your very, very rich friend who lives overseas, who has $10 billion dollars and wants to give you endless amounts of money and never see you again. Of course, that's not ever the case. But what I'm saying is when you have the 20 people and one person invested $1,000 for a 0.03% stake, they're always going to be the biggest problem. Never fails.
yeah. And this is forecasting the next slide a little bit, but the process of forming a holding company it forces you to kind of take stock of who's involved right now, right? It's always better to if you know you're expanding and you're creating, let's say, a quick serve concept, and you think, you know what, I know I'm going to create five of these because my whole business plan depends on my ability to scale. It's always better to create the holding company from the get-go, right? And
Mhm.
then set up your locations through subsidiaries. Then you avoid having to kind of do the restructuring later. That can be, time intensive. It can be expensive. It can be a headache because you have to kind of negotiate with all the stakeholders, with all the investors to figure out what things look like at a consolidated basis.
Let's talk about that for a second. It's a question we get all the time.
Mhm.
When do I form the holding company? Now, we don't always know after our first restaurant whether it's going to be a hit, whether
Right.
we have a brand that's actually going to work. So clients say like, oh, I'm about to open my first restaurant. Should I start a holding company? I know ultimately I want to start a hospitality group.
Yeah, if you know ultimately that your goal is to start a hospitality group, you might not be sure what brands are going to fall beneath that group, but you're saying, look, this is location one of several of, I don't know yet, but it's definitely I'm definitely going to open multiple concepts with the same team. I would suggest starting a holding company for those groups now. It'll
Mhm.
just save you a lot of headache and time and cost to roll everything up later. If you already have a few locations and you're thinking, oh, I might want to start a hospitality group, always better to do it sooner rather than later. The more concepts you try to consolidate, the more complicated that becomes, and the more stakeholders, have opportunities to kind of disagree at what things look like at the parent company level. So sooner is always better, and sooner is certainly always cheaper. Um, but it's not uncommon, right, for our clients to kind of change their mind as they go. What started as what you thought was a standalone, maybe it has incredible success, and now you're starting to look at the concept a little differently. And you're starting to, now that it's off the ground, think about, oh, this could actually be something. That happens honestly more often than not. So it's definitely not impossible to roll up after the fact. We'll talk about that in the next slide. But for right now, I do want to talk about more holistically what the benefits of a holding company are.
Let's do that.
So we talked about, basically the holding company being a bridge between your various, ventures, whether it's a pop-up, whether it's a catering business, a commissary kitchen, a series of restaurants, a series of management deals. It doesn't matter what you have in your portfolio. Parent company creates an opportunity to create a bridge between all of them. That
Mhm.
means profits all flow up right to the same place. You have consolidated tax returns, so it streamlines things from a tax standpoint, streamlines things from a legal standpoint too. Instead of having four restaurants with four different operating agreements or partnership contracts, you have one, right, that covers everything. So you don't need to worry about, oh, I don't remember what restaurant number three's operating agreement says about this. It's weird that it says this, and my restaurant number two says something totally different. It just avoids having, the inconsistency of having basically everything be its own island, and not having the connectivity between your locations. If your goal is to really consolidate, parent company is the way to go. Makes it easier to raise money, right? Investors are always excited investing in a brand level as opposed to just in one location. You invest in one location, you're at the mercy of that lease, right? Of that landlord, of that brick and mortar. It makes it a much riskier endeavor to invest in just one location as opposed to a brand that has, theoretically infinite potential value. So it makes it easier to raise money for investors, lets you raise at a higher valuation too, most of the time. It also
It
creates
also
edge
shows your
adoption.
investors that you're forward thinking.
Right.
Investors are, everyone's interested in a restaurant for the classic reasons. It's sexy, it's fun. I can say I own a restaurant, I'll get a good table. But savvy investors, the ones you want to invest in a brand. They want to invest in someone who sees the big picture.
Right. Right. It also makes it easier if your goal is to eventually sell, right? Having a parent company lets you sell everything all at once if that's your goal, as opposed to structuring, if you have four restaurants without a parent company, you'd have to negotiate four separate sale agreements, as opposed to being able to bundle everything at once. Having a parent company does not mean, by the way, you have to sell everything all at once, right? You can still sell off the subsidiaries one by one, but it gives you the option, right? And I think that's a big theme of why forming a holding company is important. It lets you adapt, right, as you go. It lets you streamline, it lets you consolidate, it lets you figure out what the next step is. And a big theme of this webinar is the idea that it lets you take advantage of economies of scale. A good example of that is, as you grow, you'll probably have key employees that split their time between multiple restaurants. Where do you hire them? Right? If you don't have a parent company, you'll have to hire them four times at each of your locations. That can create uh, risk actually and liability potentially from a labor compliance standpoint, because you have a GM who's making 100K a year. That's all well and good. They're not eligible for overtime, but if you split their salary three ways and now they're 33K three times, all of a sudden now they're eligible for overtime, and it puts them in a different legal category from an employment standpoint. So it's
Mhm.
an example of how you can kind of get caught off guard sometimes by not having a parent company, right? Or not having a bridge that connects everything. Um, Holding company also lets you create bulk orders, right? You can order things in bulk and distribute them to each of your locations. If you don't have a parent company, you kind of can't have one location pay for, inventory for all four, you have to order them 4 separate times, and you lose out on some bulk discounts there. Liquor Authority also has some warehousing benefits to having a parent company letting you order your liquor in bulk as well. So all this to say, lots of different reasons why a parent company can help kind of save you money and help you grow.
I mean, this is not to be overlooked, especially the centralized bookkeeping and the bulk orders. We are digging for points in this industry. We're digging to get to 10. We're digging to get to 11 or 12. And every time that you can make a little extra money, you have to look at it very seriously. It's just a different game right now. You can't be fast and loose. We got some questions, Andrew. You ready for a couple of them? I
I'm
can't
ready.
ask all of them. Someone says, what if your business is not set up this way already and you have three different businesses with different ownership? We're going to actually talk about that. That's
Mhm,
called a roll up, and it can absolutely be done. We do it every day. There are tricks to it for sure, but it can be done.
mhm.
Um, I have a single location restaurant that's an S corp. Now I have some brand licensing deals and JVs that's all under the S corp. I didn't plan on this. How do I fix this and use the structure of LLCs? How do you do that? Is it possible? You don't have to tell us how. Just can it be done?
It can be done. It's going to be fact specific. I need to learn more about that particular circumstance. But people who get stuck with it with S corps, you have a choice. You can keep things in the S corp and just fix things on a moving forward basis, or you can kind of restructure. If it's just contracts, you can try to assign the contracts over to an LLC, right? A new LLC, and have everything flow up. It's a little harder if you own a restaurant that has a lease with an S corp and all the licenses are in the name of the S corp. You can you can move it to an LLC, but you basically have to enter into a sale with yourself or do a restructuring that unfortunately will probably come with a tax bill. As much as you could say I'm selling myself everything for $1, there are tax implications there, and you can do it. It's just unfortunately it's not as easy as just checking a box and electing something different on your tax return.
Yeah.
Um, so it definitely
So
can be done, but if you're building a hospitality group and you have an S corp, just a lesson learned for next time. Just make sure any future deal you do is in the name of an LLC, and that'll kind of help your future growth proceed the way we're talking about.
let's move on. And folks, thank you for all the questions. Some of them actually would require legal advice, so I'm reluctant to ask them of Andrew at this point, but maybe we'll revisit some of them later. Why don't we move on to the next slide?
Yeah. Sure. So this is kind of a visualization of what a traditional holding company structure looks like, right? You see that all of your ventures, for purposes of this example, we can say, all of your brick and mortar locations, although, you don't necessarily need to limit creation of new LLC to a brick and mortar. They all have their own LLC, and those LLCs are 100% owned by the parent company. Your profits and management fees flow up to that parent company. Parent company is owned by you, your partners, your investors. That's where the ownership lives. If everything is owned by that parent company, everything flows up nicely, and your expenses are paid at the subsidiary level. So, let's take venture number one in this slide. That will have its own lease in the name not of the holdco, but in the name of Venture One LLC. It's very important as you structure this to try to keep your holding company out of contracts as much as you can, because the whole
Mhm.
benefit of the holding company is it creates uh, a separation of liability, right, between the ownership and the actual operations,
So if
right?
the landlord sues you under venture number one, your restaurant, they can't come after the holding company unless you were silly enough to make the holding company the guarantor.
Um, yeah, it happens sometimes, and it's sometimes arguably better to do that than to do a personal guarantee, but different people have different preferences there. Um, it's important to just understand that just because those ventures at the bottom flow up ultimately to the holding company, you still have to create bank accounts, have records, have, um, accounting that's specific to each location, right? It's not that everything's consolidated and paid at the holdco level. If you do that, you're not going to get the benefit of that insulation. So when you're structuring this is always kind of a marriage between the legal and accounting minds. You want to make sure your accountant knows what's going on and how you want to structure this. On the legal team, we usually like to circulate organizational charts before we undertake any kind of roll up or restructuring, just to make sure the legal and accounting teams are on the same page and understand how everything's going to flow. We can paper things perfectly on the legal side, but if we don't have our accounting house in order, that's where lines can start to get blurred, and some of the advantages that we're talking about you can start to potentially lose if you don't observe the proper kind of formalities. But generally speaking, if you're looking to scale, this is the way to do it, and this is how every large hospitality group you've ever heard of has things structured.
I can't overstate enough the importance of a good accountant. We have some on this webinar who are viewing, but they have to be by your side for pretty much every decision you make when it comes to structuring, because we want them involved. We want them telling us and working with us and you to set it up so it's the most advantageous possible, because taxes, as you know, are a killer. And if we can save, again, digging for points, if we can save a couple of points by structuring things a different way, we're going to do it. So your accountant comes in now, not later.
Right. All right. Yeah, so this is actually speaking to one of the questions we got in the chat. What does this look like, right? More often than not, the process for creating a holding company takes place after you have, one, two, three, sometimes more locations, right? And it's possible to basically convert those existing locations into this holding company structure. You would basically swap equity for new equity at the holdco, right? So instead of having each restaurant be owned by a series of human beings, you basically, as human beings, say, I'm going to pledge 100% of my equity to this holding company in exchange for the holding company taking over equity in the restaurant.
Let's stop there. Let's stop there because those are, those terms can get confusing. The way this is structured, correct me if I'm wrong, is the holding company now owns 100% in our example of each of the three restaurants,
Hmm.
right?
Yep.
Currently, and this is why it's a conversion, you may have different ownership in venture one, two, and three. They could be different people, different owners. So you have to, Andrew, how do you do that? So I've got three partners in one, four in two, three and three. Some of them overlap, some don't. I want
Yep.
to bring them all up to the mothership.
Yep.
How do we do that?
That's the biggest challenge, right? The is figuring out what does the consolidated ownership structure look like. That is going to be an accountant's in the accountant's ballpark. We would work with the accountant to figure out what is the valuation of each of your companies and what should a consolidated ownership look like. Right? A lot of people make the mistake of thinking, you have an investor who owns 5% of location one and 10% of location two. So naturally, they'll own 7.5% of the holding company. It's not
No.
necessarily true, right? Because location one might have a different valuation than location two. You might want to reserve some equity at the holding company level for a new raise, for example. So you basically want to figure out who owns what right now. You want to come up with a valuation for each of your current locations and then start to do some back of the napkin, planning of what would a consolidated org chart look like. On the legal side, I generally don't actually start papering any legal documents to effectuate a roll up until all of the people being rolled up more or less agree on a final org chart or end cap table for the parent company. Because this is something that you'll have to basically get people on board with.
How
Do
do you
all of
spell
your
that?
investors need to agree? Depends on your operating agreement, right? Depends on the contract you signed with them initially. Do you have the right to force them to roll up? Really depends. That's case by case, and it depends on the contract that the investors signed initially.
Let's say you don't have the right, and we do like to have the right to roll people up in our agreements if possible. But let's just say you have a total of eight investors, and two of them, one from number one and one from number two, are not that interested. First of all, before we even get to that, how do you approach your investor group, and what's your pitch?
Yeah, I mean, your pitch is it's going to be, it's going to be customized depending on what you've already told them. But if I let me put it this way, if I'm an investor and I have an opportunity to get rolled up into a larger brand holding company, I am very excited because what you're telling me is there's no ceiling on the value of my investment anymore,
Hmm.
right? If I'm invested in just one location, great, the lease might not get renewed, right? There might be flooding, there might be a lawsuit. My investment is very fragile if it's just one location. There are a million and one things that could go wrong. But if I'm now an owner at a parent company level, now I have a smaller interest in many different things, and I'm much more likely. There are many more reasons why I'm going to get a distribution check at the end of the year. So I'm excited about it, right? Do investors generally understand this? Yes. And I think, for those of you who have gone out and raised money before, you're likely encountering this question before they even give you the first check, right? To say, hey, I'm investing at the brand level or not. Investors really care about this because investors know the hospitality industry has a high failure rate. They want to insulate their risk. If they invest at the brand level, they know it's safer for them. So investors are savvy. They'll probably want that to begin with. If they don't have it now, you can say, oh, well, it's your lucky day. You're going to invest at a brand level, and now it's a much safer investment theoretically. The challenge becomes getting them to accept not the concept of the roll up. That's easy. The challenge is to get them to accept the math, right? Because where investors are likely to object is to say, I don't think that valuation makes sense. I don't know why I own 4%. I should own at least 5.5% based on my calculations, that are apropos of nothing. That's when you would have to have a sit down conversation. That's when your accountant might want to, show them how they valued each of the businesses and get everybody kind of conceptually on board with those details. Roll
So
up, live or die by those details. If you get everybody on board with the numbers, you're good to go. If you can't get them on board with the math, it becomes a lot harder.
a lot of people are asking, what if two of them are crushing it and one is just middling?
Mhm.
How do you get the people who are crushing it to roll up into the other one? I'm going to answer that. And I'm going to say, well, Jesus, if I've got two out of three that are crushing it in this industry, and I've shown that I can do two out of three, and I'm going to open up five more, you don't want to be left behind, is what I would tell them. I'm going to say, I've learned my lesson on the one that's not crushing it, but we're going to open up a lot more. You want to stay with one? No problem. But I'm going to open up 10. And then
Right.
where are you going to be? I'll let you roll up later, but now the valuation is going to be 10 times what it is today. So you got to be a salesman. You got to show them the bright side of things. Um, and if they don't want to roll up, they don't have to.
Right. An alternative is, if you don't have the contractual right in your operating agreement to force them to roll up, keep them where they are. You'll probably want to buy them out eventually. But you can say, look, the train's leaving the station without you. You're just going to stay attached to this location. Maybe this location sticks around forever. Maybe it doesn't. Right. But again, they're losing out on an opportunity to invest at a brand level and potentially in a holding company that sits above multiple brands. It all really your leverage in this situation depends greatly on what the contract you initially signed with your investor says,
Mhm.
right? So we're speaking in generalities, but your leverage to have those conversations really depends on what your contract says. If they already own the intellectual property, if they already have the right to prevent a roll up, it's probably going to be a different conversation. And you might want to, instead of saying, okay, you can keep what you have and we won't roll it up, maybe you want to offer them a buyout to say, look, you clearly don't believe in this vision. We're going, in X direction, you want to go in Y direction. Let me just give you a return on your investment and then some, and we can, I'll accelerate your payback and we'll go our separate ways. That
And
happens a lot too.
you have to be a diplomat about it. Go to the top investors, convince them, get a wave going. And once you start getting the top investors saying, I want to do this, typically the rest will fall into line. They're thinking, man, that guy who's got the biggest chunk is rolling up, and the guy under him's rolling up, and the woman under him is rolling up. And then the bottom three are like, I don't want to miss out on this train. So you got to be strategic about who you talk to and when also.
Yeah. And it's also a good opportunity when you're rolling up to think about your relationship with these people. Are these people you want to be brand partners with? The answer might not be yes. Right. And again, whether you have to roll them up if you're doing a roll up depends on the contract. But we have certain, clients that take this opportunity when they're at this stage to say, you know what, I have some money in the bank. I actually want to trim down my cap table because when I'm thinking about who I want at a brand level, who I want to be part
When you
of
say, I'm
not
sorry,
one
Andrew, when you say
location.
trim down your cap table, you mean you want to buy out some investors, right?
Yes.
Okay.
Yep. Yep. Um, so that's a good opportunity to do that, right? To say, look, before I even get started with this, this person is, this investor just doesn't get along. We have so many issues with location one. Imagine if they were all of a sudden part of a parent company that touched three locations as opposed to one. Complications might compound, right? I might have triple the problems, triple the headache. I don't want to do that. Let me talk about a potential buyout and let me structure that. There are ways to do that. Obviously, make sure you talk to a lawyer when you're structuring that because you're right to do that. Whether you can compel a buyout or not, how you go about that will depend on, again, on the contracts that are in place already. But it is a good conceptual time to, it's a time to kind of conceptually think about who do I want to take this next stage with me, right? Who's coming with me on this next chapter? Um, so, we have clients come to us saying, hey, I'm thinking about a holding company and I'm thinking about a roll up. And they don't even start papering the roll up documentation for another 2 years because they're putting together cap tables and buyouts and they're getting everything ready. Right.
Mhm.
Part of the why it's better generally to start with a holding company is you can avoid that preparation process. But most of our clients underestimate how long it takes to kind of figure all of these details out. Once all the details are figured out, the legal paperwork really isn't too hard. The
Which is
only other
why
obstacle, yeah, go ahead, David.
which is why it comes back to setting things up correctly from the get-go, meaning that all of these problems disappear if you start a holding company from the start. If you start a holding company from day one and you figure out who's going to own the intellectual property, which is a big deal that we're
Hmm.
going to have to talk about, and you set it up that way and you know this is what you want to grow, we don't have these problems. They don't exist.
Right.
This is for people, this conversion is for people who started one, brought some other people into two, and now they want to roll up to three, or they have the same people in one and two and they want to roll up to a holding company and never really thought about it.
Hmm. Yep.
Um,
Another reason why it's good to get ahead of this is keep in mind it's not just the investors you necessarily need on board with this. Sometimes you'll need your landlord and or lender to consent to this new structure.
wait,
Um,
hold on. Landlord, how's the landlord involved?
so it depends on how your lease is worded. Some leases basically say if 50% or more of the equity of the tenant changes hands, that's considered an assignment of the lease that needs landlord consent. Some leases exempt from that internal restructurings, right? If David and I own a company together and we're 50-50 and we're rolling up to another company that's also 50-50, that's generally fine, right? Because the landlord, the whole purpose of that is the landlord wants to know who they're in business with. That restructuring is actually a good thing from a landlord because we're rolling into a holding company that's potentially more streams of revenue we have access to now to pay our rent. We're much less likely to default as one restaurant in a collective of eight as opposed to one restaurant in isolation on its own. However, not all landlords are rational people, right? Not all landlords want to be bothered with these requests. Not all landlords want to take a look at your org chart and your, you know, nice polite letter to say, Mr. Landlord or Miss Landlord, can you take a look at this and approve my restructuring? They may say, I have no obligation to do that, and no, thank you, I don't want to. We've seen that
Well,
happen a lot.
it's been our experience that anytime you ask a landlord for any goddamn thing, what do? They put their hand out. They put their hand out and they say, yeah, sure. Actually, you can't do this, but I'll let you do it for a price. So again, take a look at your lease. Make sure you have someone good doing your lease to make sure you can internally restructure
Right.
without having to ask for the landlord's consent. Maybe you have to notify them. That's fine. As long as we don't need something from them where they can then turn it around and extract money from us.
Yep. Same logic goes for loans, right? If creditors have the same language in their loan agreements, and it's potentially risky to do it without landlord or creditor consent because that could trigger a default on the loan, and all of a sudden your entire loan balance becomes due overnight. Um, Again, if you're paying your loan on time, the risk of that even necessarily being discovered, not terribly high, but it's not a risk that's worth taking. So definitely take a look at your loans and your leases in anticipation of doing this because these are consents we'll want to secure for sure. Um, Yet another reason why getting ahead of this and doing this earlier is much better than waiting until you have eight locations and say, okay, we're finally at the point of rolling up, let's do it. It's going to take a lot longer. If you have one location that you're rolling up, that's much easier than rolling up eight. How long it takes generally depends on how many businesses you have to consolidate.
Okay. Why don't we move on to how we're going to fund these new ventures?
Yeah, so part of the position, of rolling up is to part of the argument for rolling it up, right, is to position your hospitality group for growth. Whether you're building on an existing brand, creating a new brand and folding it underneath your holdings, it's up to you, but chances are you're going to need money to fund that growth. You have a choice. You could reinvest profits into that growth and not take on, more debt or take on new investors. You can do it that way. Just keep in mind that if you told your investors previously, hey, we're going to be distributing profits every year and here's what we're doing, if that suddenly changes and now you're moving to more of a growth versus a cash flow model, you talk to them about it and make sure there's nothing in your contracts that prevents that. When you're shifting gears to a holding company, you almost want to have a brand new conversation with your investors to say, look, you raised money in one location. Here's how we did. Now we're part of a larger group. Here's how we're going to be doing. And the roadmap changes a little bit. So getting ahead of that conversation and talking to investors and adjusting their expectations is really important.
Is there always a raise attached to a roll-up?
Not necessarily. You don't have to, but a roll up is often inspired by a desire to say, look, I have three, I want to open another two, and I need some money to do that.
Hmm.
So, from a practical standpoint, I'd say it's about 50-50. 50% of roll ups, are in anticipation of a new raise. You often reserve a portion of that new holding company for sale to new investors. Generally speaking, you want to give your existing investors, the first bite at that apple, so to speak, and to say, look, we're raising some new money. We'll come to you guys because you're our existing investors first on these terms before going to new investors on the same terms.
When you're pitching it to investors to roll up, aren't they usually saying, yeah, I'll do it, but I want a right of first refusal to invest? So you're saying, look, we're doing a roll up. You're going to roll up. Your 10% in this company is now going to go to 3% of the holding company. And we're also raising $1 million. And we're going to raise it from the people we want. Do they always say, well, I want that opportunity first. I don't want you to go outside and I can say yes or no without being penalized other than losing some equity if I don't?
Yeah, it's a good question. Again, it really depends on the contract that they've signed, right? What you're talking about, David, is a preemptive right, and most investors have it. It's a very standard term that you give investors. You generally never want to tell investors, "I won't dilute you," right? Dilution is a symptom of success. And everybody gets diluted generally when you're raising more money, including the founders. And again, that you have to make room for money as you keep growing, and dilution is not necessarily a bad thing. A lot of investors get hung up on the concept of dilution and think, oh, at no point should I have my percentage reduced from 10% to 9%. No way. You can say, okay, but if everybody has that approach, then there's literally no room to take on new money, and we can't subsidize growth, and your valuation's capped. Congratulations, we're stuck here forever,
Mhm.
right? So we're never going to tell investors we're not going to dilute you. What you do tell them is if we do approve a dilution event, and that approval is often a major decision that can or sometimes requires investor consent, depending on how your initial contract's drafted, that will give you an opportunity to prevent that dilution by buying into the new raise.
Right.
That's very, very common. Even when we represent companies versus investors, it's almost always in the contract because it's very hard to justify not including a preemptive right in your document. It can happen, but it's very common to do that.
So if you're raising money, you go in the holding company, you go to your existing investors, you say, here's the raise, it's $1 million, it's 100 to you, 10 to you, blah, blah, blah. Some people say yes, some people say no. Those who say yes keep their equity percentage where it was, and those who say no get diluted. And that frees up equity to go to market and sell to others at whatever valuation you decide, correct?
That's right.
Okay.
That's right.
How many people actually fund at that stage? How many fund new ventures with loans? Isn't that pretty uncommon?
It can be uncommon. Loans have pros and cons, right? The pro is you're capping the amount you eventually have to pay back, right? With equity, equity can be very expensive for successful ventures because once you give somebody equity, they have a right to profits forever.
Hmm.
Whereas a loan, if you're very confident, hey, we're going to get a loan with a favorable interest rate, we have an amortization schedule. We're going to pay this off in 5 years, and we won't, it won't even really affect things. And there's no way virtually that this loan is going to put us out of business. Some people do that and they save a bit of money, but you generally steer away from loans, particularly as you're scaling, right?
Mhm.
Because once you're starting to get to the holding company stage and you want to open, more locations quickly, you probably need a lot of money and you generally don't want to have too much debt. Because you never know what's going to happen. And we've had a lot of clients take on loans thinking, oh, this will be a breeze paying this back. And then something like the pandemic hits, right? Or something unexpected. And all of a sudden now you can't pay it back. Now you're in default on this loan and the whole business goes under before it has a chance to get off the ground. Equity investments are more common for that reason. You pay them back when you can. Um,
So usually from what I hear you saying, funding new ventures is typically a combo of capital call and authorization of new equity.
Not necessarily. A capital call is basically just asking existing investors to contribute additional amounts, and if they do, great. Their percentage interest typically goes up. If they don't, great. Your percentage interest typically goes down. A capital call is a way to raise money. I think it's much easier to just authorize new equity and give your existing investors first bite at the apple. It's kind
Mm.
of the same thing. The difference with authorizing new equity is you're opening that possibility of bringing in new investors. Let's say, you want to raise, I'm making a number up, $100. You have $50, taken by existing investors, but now you're down 50. You still have to raise 50. In a capital call, you don't have a mechanism to do that because it's limited to your existing investors. Authorizing new capital allows you to bring in, or sorry, authorizing new equity allows you to bring in new investors in the event that your current investors don't subscribe for the full amount.
Mhm.
Good way to think about it is, let's say your holding company has 100 membership units, or think of them as shares. Your ownership is just going to be X over 100, right? You want to raise some more money? Maybe you authorize another 20 shares and you tell your investors, look, I'm raising X number of dollars for these 20 shares. Everybody has an opportunity to buy in. Your new ownership is just X over 120.
Okay.
It's an easier way to do it. But when you see capital calls, that's one of the ways to raise money. But in most cases, it's not my personal preference because it closes the door to potential outside investment.
Got you. Okay, let's move on.
Um, so yeah, as you start to build out your parent company structure, what's common is creating a management company. And that management company stands in for you as the founder. You as the founder would own equity in this management company, and that management company would own equity in the parent company. So your management fees would flow to the management company. Why do you do this? It creates a vehicle through which to do a few things. One, creates potential for new revenue streams through consulting and management agreements. Let's say, David and I are owning and managing a really successful, I don't know, coffee brand. David, just going off of your history with coffee companies. Let's say we have a coffee brand and we want to consult for something totally unrelated. A doggy daycare is like, hey, I really like your style. I know you're great with P&Ls. Could you just take a look at this? That's an unrelated revenue stream to our coffee business. We might be able to, depending on what our contracts with investors say, take on that consulting opportunity without involving the rest of the structure because it's unrelated. A lot of management groups do that and take on these one-off projects as long as it doesn't distract them from their core business, as long as you're not diverting resources or doing anything to breach confidentiality or fiduciary duty. You can use a management company as a platform to enter into kind of side consulting and management deals.
Yeah, you gotta be able to pay your rent. You gotta be able to feed your family. So investors are usually okay, unless it's not egregious, with side gigs is really what they are. They're
Mhm.
side gigs based on your your professionalism and your abilities to help others. So if somebody wants to come to you and say, consult with me on this thing, this has nothing to do with the company. This is about you and your skills.
Right.
And we always like to try to carve that out in our agreements because they do come up. And maybe it's 10 grand here, 20 grand there, 30 grand there. It's worth it. It's worth it. You
Right.
need it. And everybody's happy about it because then you're not the starving owner. And believe me, we've seen that way too often.
Right. It can also create a vehicle through which to hire shared personnel, right? So let's say, your hospitality group, you guys are crushing it, and you want to hire a director of operations to oversee kind of everything you have now and everything you're planning to create. You might want to hire that director of operations through your management company or through a payroll entity that you place underneath it. I didn't want to overcrowd our visuals here with too many entities, but think about the most famous hospitality groups out there. These org charts are extremely complicated. The org chart we're showing you here is pretty simple, but you might have a separate payroll entity. We'll talk about an IP holdco. We'll talk about different holding companies. You can start to kind of create a web of companies that situate you for growth. The holding company is kind of I'm mixing metaphors here, but the nucleus, right? Everything kind of flows to and from that parent company. So a management company creates a little branch, an extension of your hospitality group that can do just a number of things and opens up possibilities for you.
It also allows you, correct me if I'm wrong, Andrew, but within that management company to make an agreement between the partners, between
Right.
the managers, because sometimes it's not a 50-50 deal where we're both doing the same amount of work. Sometimes one of the managers is more important than the other, or is working it as a full-time job and the other's doing it as a part-time job, or whatever the case is. But the managers can have their own agreement within the management company, correct?
Yep, absolutely. Basically, you have your own operating group. Every LLC needs an operating agreement. You'll have an operating agreement with your investors. This is a way to remove some of the intricacies of your deal with other co-managers and take that out and make it its own agreement, right? So that the investors see an agreement between your management company and them. You'll see both. You'll see that management company deal, but you'll also see kind of your more private deal with your co-managers. So it's a good way to solidify, memorialize, and in some cases revisit, right, your relationship and the roles of your managers because as you scale, job descriptions are gonna adjust and evolve over time too. So the management company kind of is a good idea for a number of reasons, but it also forces you to kind of sit down and take stock of where you are as co-managers and how your roles are and will continue to evolve.
Yeah. It's an important piece of the puzzle. And a lot of people have confusion about where it sits and what it does.
Yeah,
But I think you've spelled it out nicely. Shall we move on?
let's move on. So yeah, we talked about the management company being a vehicle for growth through the personnel that you can hire, right? So David and I wanted to put together, a list of some officers that growing hospitality groups often hire. Director of operations, culinary director, CFO, HR, PR, director of development. Different hospitality groups will prioritize different positions. It really depends on who the founders are, what their skill sets are. You'll want to hire key personnel that kind of complements what you have already. But again, the management company gives you a vehicle through which to kind of hire these people and potentially even give them maybe some sweat equity, right? In the bigger picture, that's a whole other conversation. But um, it's something to think about, right? As you grow, you're going to need help. You're going to need kind of some employees that are focused on the big picture and aren't just you know stuck in the trenches of your individual restaurants. You'll want some higher level employees thinking about the big picture with you also. And David, I know you always have a lot of tips and tricks and thoughts on this.
Well, most owners do a lot of these jobs, and you start out certainly being a DO. You start out oftentimes, if you're a chef, being the culinary director. Oftentimes, you are also the CFO, which is incredibly important, by the way. Everybody should think of themselves as their CFO, and you have to know the numbers. You have to understand the financial aspects of running a restaurant. HR and PR typically are farmed out. And of course, owners are always the director of development. However, as you grow, you have to start changing your mindset and stop thinking of yourself as a front of house person or a back of house person and start thinking in terms of restaurateur. And it's a larger role that encompasses everything. And when you start thinking of yourself that way, you'll feel that you have to actually fill in all of these roles. You shouldn't be doing any of these roles. Certainly, you'll always do a little development. That's kind of part of your job to help grow the company. But all the other stuff should be other people. And then you, who founded the company, who is the entrepreneur, who has the fire under their butt, is going to grow into multiple ventures. You're going to find the opportunities. You're going to be traveling around the country. You're going to be talking to important people to grow the company. But you got to get out of that mindset of only I can do this. It's just not true. And you're going to have to train people. You're going to have to find good people, and you're going to have to pay them way, way more than you want. That's just the truth of it. Um, Somebody asked the question, why hire them at the management company versus Holdco if Holdco owns all three properties? Good question.
Yeah, it really depends on your structure, but in this example it's on the screen right now, it's more common for the management company to own a piece of the holdco, right? So whether you own equity in the management co or the holdco, you still own equity in everything. It's just a question of whether you own equity directly or indirectly. So it's not really a question of equity. It more often comes down to insulation of liability, right? If I was an investor, I'd prefer not belonging to an entity that hires people, right? Because I just don't want any chance of veil piercing employer liability to attach to me. So a lot of times when you're hiring, you have a management company to do that hiring to insulate investors from liability. More often than not, you actually place a payroll entity under the holdco, and hire them there, and that way the managers are insulated also. I just decided not to include a payroll entity in this visual because these org charts can get very complicated very quickly, and we wanted to keep this conversation kind of high level. But it's a good question. There's nothing wrong with doing that. If you have a parent company, you don't have a management company, you have some contracts at the holdco, there's nothing wrong with that. It's really just a question of risk. The bigger you get, the more you want to avoid that, though, because there's more at stake. And the cost benefit analysis starts to shift in favor of keeping everything kind of in its own channel.
We want to keep a force field around the Holdco. We want to we don't want anybody reaching their hands into the Holdco to try to get at us. And what is life like in New York City restaurants? Life is in all restaurants. Everyone's knocking at the door every day. Oh, I got a labor lawsuit. Oh, I got a discrimination complaint. Oh, the Department of Health is up my butt. Oh, on and on and on. And everyone's always knocking at the door with their hand out. So if we can create a force field around the Holdco, it's going to protect you.
Yep.
Okay.
This is a good question. Our industry standards is as industry standard, are the C-suite level employees billed separately to hold the holdco subs? Are they included in the management fee? So it's a good question, and the answer is it depends. At some point, yes, you're getting a management fee is basically the compensation that founders, meaning owners, pay themselves. Um, at some point, you have to reconcile that management fee with labor costs generally. It almost doesn't matter whether it's included in the management fee or not, because once you scale, it's going to be about what is your overall labor cost. Whether it's a part of the management fee or not, it depends. The bigger you get, the less likely it is that your management fee covers those salaries. It really depends on what those management fees are. Um, and it can adjust, right? If you 5% is a typical management fee, pay yourself about 5% of gross revenues. If you have one founder who's only working 10 hours a week, you're probably sharing some of that 5% management fee with other officers. But if you have five founders who are working 80 hours a week and now you need a CFO, you're probably billing the CFO salary against all your other locations. That's one that's very hard to give you kind of a general answer. It really depends. But my advice is always look at the management fees in relation to the broader labor cost and figure out what makes sense.
So it really depends on how much money's in the pot, in the management co-pot, right? Is that
Mhm.
what you're saying, Andrew?
Yeah, basically. I mean, what is, 5% management fees? What is that, right? And what is a reasonable salary for your founders to get paid? And how, what is that in relation to the overall labor cost? If founder salaries are too high and there's no room for other people, you might want to share some of that management fee with the CFO or COO, depending on what it is. You just have to look at, again, the labor cost on a macro level, which includes the founder fees.
Let's talk about a little bit more about management companies. We've covered some of this as a
Yeah.
vehicle for growth, but go
Yeah,
ahead.
this is just a visualization of what David and I were talking about earlier, and that Management Co. being kind of a jumping off point, right, for you to enter consulting deals, management deals, other things, and have the Management Co. start to pool money, not just through management fees, through kind of your branded operations under the Holdco, but you can potentially enter into some side gigs and flex your managerial team's muscles and consult for other groups as well. You want to be very careful when you do this to make sure you're not violating any kind of exclusivity clause or non-compete in your deals with your investors in the holdco level. Generally, these agreements say that, it's not necessarily exclusive. You can have side projects if you want, but you want to make sure you're not overextending yourself and stretching yourself too thin on those side projects. But this just gives you an example of how a larger hospitality group often goes about it, and how a management team can have, their feet in lots of different pools here.
You got to be careful with these, especially with management deals, because management deals take time.
Yeah.
Management deals mean that you are going to manage somebody else's F&B property. And that's going to take your time. And maybe it's not you, maybe it's someone on your team, but the holdco owners might say, hey, 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 where are you going? You got three management deals. How come you're not spending time on the places that we own? So sometimes, Andrew, it is possible that the holdco is going to want to participate in some of those fees, right?
Yes. Yep. It's definitely possible, and we see that sometimes, right? Where it's like, look, if we're essentially loaning your time out to another project, maybe, you take a portion of the fees that you would otherwise collect and pay some of that to the holdco, and that way the investors can participate also. Really
Right.
depends.
And
I
it's
think it also
interesting
depends
that
on
you,
what stage you're at, right? You might have gotten, the holdco structure to a point where it's a well-oiled machine and you don't need a whole lot of time there. Your time for the holdco will be needed if things are going poorly, right? Or you're in growth mode and expansion mode. But if you're in a maintenance period, maybe you do a 2-month consulting deal and, there's no problem with it. So it really depends on your ability to kind of forecast the needs of the businesses. And again, err on the side of overestimating as opposed to underestimating the amount of time that these side projects can take.
it's interesting that you did not include licensing deals, but I think we'll talk about that next.
Yeah,
Let's do that.
yeah. So as David forecasted, the next thing we want to talk about is intellectual property and creating intellectual property holdco to own intellectual property. Intellectual property is a fancy word that, in the case of a hospitality business, basically just means your brand, right? It's your name, it's your logo, it's your trademark, but it's a lot more than that, right? It's your menus in some cases, it's your recipes, it's the look and feel of your restaurant. It's everything that makes it distinct that you wouldn't want other people to copy, right? It's a combination of things. It's kind of an amorphous category, and it's very important. One of the reasons why you're creating a holding company in the first place is to leverage your brand, right? To take advantage of economies of scale. Protecting your brand is one of the most important things you can do. We have a trademark webinar coming up later in the series that speaks, to these points in greater detail. But the important thing to remember is the company's brand is an asset. It's intangible, but it's an asset, meaning you want to protect it. The best way to protect it is to park it in yet another limited liability vehicle that will live off of the holding company, kind of as it's framed here. That company will give your restaurants and your operations a free license, generally it's free, to use the brand in its regular business. The reason you move it out into its own company, again, is to just protect it. I like the force field metaphor David used, protect it from any liability, insulate that asset, particularly as you start to, apply for federally registered trademarks. It's a valuable asset that you'll want to insulate to the greatest extent possible. It
It brings up
also, yeah, go ahead.
brings up one of the most important questions that you have to answer when you're starting a company. And that question is, who owns the IP?
Hmm.
It is the number one question. It's a question that very few people ask unless they talk to us. Um, and Andrew, why don't you explain to us why it is so important to ask that question and what the answer means?
Yeah, if you go on LegalZoom, Rocket Lawyer, you download an operating agreement online, it's generally not going to talk about intellectual property, right? And even the term intellectual property, you think of tech companies, you think of patents, you think of, hard science. It's easy to forget that IP is broader than that, and it stands for brands, right? In hospitality, branding is everything. So when operating agreements don't talk about who owns the IP, it's the default is the company owns that IP. If I'm an investor in a company, and let's say David is the founder and I'm an investor and I'm just a pain in his backside and I'm the worst and I ask him a million questions a day and he can't wait to get rid of me and he wants to buy me out and I refuse to take a buyout. It's just a terrible relationship. But the business is doing really well. He wants to open a second location. You didn't talk about IP. I now have a right to join him in that second location in some way. I have to participate in that second location. You can't freeze me out because you didn't get ahead of that question. So who owns the IP? Another way of thinking of that is who has the right to come with you as you grow and expand the brand? Who has a right to attach themselves to that growth? And not answering that question initially presupposes that the answer then becomes everybody, right? Everybody who invested in the first location is going to be involved in some way in the second one. We've seen a lot of litigation kind of on this point. There are a lot of kind of common law doctrines about this that I won't bore you guys with, but it's very important to understand that by not addressing that early, you're putting yourself in the worst bargaining position later to grow. Because now, you have to bring the investors with you whether you want to or not. And a lot of times investors think that's the case automatically, and founders think the other way around, thinking, no, it's my brand. I started it. Why would I share
So let's dig into that a little bit, because there's two scenarios that come up. One is I'm opening up a restaurant. I don't know if it's going to be successful. I bring on my investors. We never talk about the IP. Hence, the IP is owned by the company. Meaning that if I start David's Coffee and it's amazing, and I want to open up a second David's Coffee, now I got to go back and I got to ask my investors for permission. And some of them can say yes, some of them can say no. Maybe we take a vote, but it's a pain in the neck. Now, if I, from the beginning, on my term sheet with my investors say, I, David, the owner, also own the IP, then they can't stop me. And that's in my operating agreement. Andrew, correct me if I'm wrong. They cannot stop me from opening up David's Coffee too.
Yeah, I mean, we would go a step further. We'd put, bold font to say, this means, by the way, that if we expand the brand, you're not necessarily participating. We want to make that very clear. It's totally fine to do it that way. You just want to make sure that investors are acknowledging that, right, and signing an agreement that says that. It's a little tricky because we're talking about IP in the context of a holding company, and we're assuming the holding company owns everything.
Right.
So if you're having a holding company, you're bringing in people at the brand level, you're sharing the IP,
Yes.
right? I think it's important to acknowledge that. If your goal is to keep the IP for yourself and bring investors in on a location basis only, a lot of the benefits we're talking about won't apply here,
Mhm.
because you're not going to have kind of that consolidation of everything. So it's something to keep in mind. Some operators say, "Look, I'll own the IP. I don't want these people to come with me." But over the course of the next few years of operations, you develop a great relationship with this investor, and now all of a sudden you want them as a brand partner, and they're going to invest in the future. So it's possible to retrade and go back on that and say, "Look, part of the roll up is congratulations. Now you'll be part of the brand." And that goes back to
Right.
the pitch of the investors that we talked about. But one of the when we were on that slide previously, one of the things we talked about was talking investors into it and understanding your leverage to compel a roll up, but also to advertise and sell a roll up to your investors. A
Mhm.
lot of it comes down to what were their expectations in the first place, and to put it more simply, who owns the brand to begin with.
Right. Thank you. All right.
Yeah, and this is just a visualization of yet another potential revenue stream, right, that would go into the holdco. Generally, the IP holdco is owned 100% by the holdco. So if you're licensing a brand to a third party, fees would go into the IP holdco and flow to, your ultimate holdco.
Let's talk about what
Licensing,
is a licensing deal in the first place, by the
yeah,
way.
yeah, a licensing
Management.
deal is basically you're giving somebody permission to use and operate your brand in exchange for a fee. Right? So you're saying, look, I've got a perfect roadmap for how to operate this particular business. I trust this operator. I'm going to give them basically a handbook for success of how to operate this thing. They're going to take on all the risk and liability. They're going to raise the money, and they basically become a franchisee to your franchisor. Um, it's when you're talking about licensing deals, it's very hard to talk about it in outside of a franchise relationship because a lot of licensing deals can accidentally become franchises depending on how you structure them. But it's a way of illustrating why the brand is so important and how a lot of these brands monetize it, right? Is through the concept of licensing deals, whether it's an IP license agreement that's standalone or through a larger franchise deal. This is a way you can potentially leverage your brand and make more money from it in a very low risk way.
Go on to John George's website, go to Dynex, Daniel Boulud's website, and see all the different restaurants that they own. Most of them are licensing deals. Some of them are management deals. And why do they do licensing deals? They do them because they're basically getting a couple of things. You get a development fee to set up the new restaurant, could be always in the six figures, mid six figures. And then you're getting a percentage typically of the gross revenue. It's just flowing into your business for what? Because you are Danielle Boulud, and this is a Danielle Boulud restaurant, and it attracts people to the hotel or the development or whatever it is. And now you've got 10 restaurants where you're getting 6, 7, 8% of the revenue, and you can imagine how much um, money you can make from these fees. The catch is you have to build your brand to get them. Your
Right.
name and your brand has to mean something for anybody to offer you the licensing deal.
Yeah. So we put this slide at the end because it's almost the culmination of everything we've been talking about, right? That the purpose of structuring a holding company is to create, like we said, economies of scale, but also to leverage your brand, right? And to build on your success. And the bigger your brand becomes, the wider known it is, the better regarded you are in the industry, the more likely some of these consulting and management and license opportunities are going to come your way. And that really helps pad both the bottom and the top lines for you.
Lovely. I think we're down to our last slide. And people who are here, if you want to start sending us questions, we're going to have a Q&A after the recap. So please send them along. Go ahead, Andrew.
Yeah. So this recap, it basically just visualizes everything that we've been talking about. This is what a simple but traditional parent company structure looks like. You have a holding company kind of in the center here. Each of your locations has its own LLC that's wholly owned by the parent company. You have a management company off to the side. You have an IP holdco off to the side. Um, and profits and management fees flow up to the holdco and or the management co. And the IP co gives free licenses to your owned operations to use them. Again, holdco structures can be much, much more complicated than this, but this is, I think, conceptually the important things to keep in mind. Every organizational chart is going to look a little different, but this is hopefully a good way to start conceptually understanding what some of these things do so that when you're thinking about your own operations, you can start to chart out where things might go. And obviously, we'd be happy to, separately talk about how to strategize that.
Well said, Andrew. Thank you. Thank you for a great webinar. Alex Randrup, who's on the ones and twos, running this thing for us. Thank you. Thank you all for attending. If you have any follow-up questions, you can email Andrew at andrew.fine@helbraunlevy.com. I'm David at helbraunlevy.com, and we do have a question. As an owner, where should you position yourself? Should you have an INC associated with the LLC?
It's a good question. I mean, a lot of owners, if you want a company, you probably will own interest in the parent company through your management company. You can own your portion of the management company through your own company, right? Whether that's an Inc., a corporation, or an LLC, it's up to you. A lot of people that own their interest through an Inc. or an LLC, it's often tax driven. Um, maybe it's better to pay yourself through an S corp as opposed to an LLC. The only time I'm generally okay with people owning an S corp is when it's a personal vehicle to pay yourself. Don't sign a lease through an S corp, but if you want a personal company and you want to pay yourself through a personal company, an S corp can have tax advantages there. Really depends, but you don't necessarily need your own LLC, especially if you and your partners, your operating partners, are owning interest in a management company that already has its own limited liability protection.
Right. I think we'll end it there. Thanks again to everybody for attending. Great questions, great turnout, and we'll see you again soon. We've got a lot more webinars coming up. If you have questions about them or you want to see the list, just send me an email and we'll send you over the schedule. Okay.
Thanks, everyone. Just so everyone knows, I saw this question in the chat, and David actually responded, but David, I think you only responded to hosts. The question was, are we going to send out copies of the webinar slides? The answer is yes. Everyone will get a copy of the slides. So if you have any other questions, feel free to reach out to me and David, but everyone who attended today will get a copy of the slides that went out today.
Okay, great. Thanks, everyone. Take care. Bye-bye.
Thanks, everyone.